Hi, welcome to 4.07 More Markets 2. This is the very beginning, starting at slide 1. You have learned about the stock market and how shares of companies are bought and sold in a stock exchange. Some stocks are safe, while others are more risky. People invest in the stock market for different reasons, but all of them want to increase their investment. When it comes to investment options, the stock market is just the beginning. There are many other markets where investors can put their money to work. Each one is unique with its own players, goals, rules, risks, and returns. To get a sense of the variety of markets available, explore 3 markets that attract a wide range of investors. They are the commodity market, the bond market, and the currency exchange market. The currency exchange market exists wherever the currency of one country is exchanged for the currency of another. This market includes all of the currencies in the world. The currency exchange market is all about investing money to make money from trading money. What does that mean exactly? Continue on to find out. In the zone. The globe is covered with currency zones. Within each zone, a country has its own currency. A group of countries might share the same currency, such as the euro. The currency zone covered by the US dollar includes not only the United States, but several other countries that use the US dollar as their official currency. Ecuador, El Salvador, and the Federated States of Micronesia are a few examples of countries that use the dollar. Other countries have linked the value of their currency to the value of the US dollar. In each currency zone, there is a monetary authority that controls the currency as well as monetary policy. The monetary authority is usually a central bank, such as the U.S. Federal Reserve or the European Central Bank. For economic activity to occur across zones, trade has to occur. Currency exchange is an extremely common form of trade. Most international trade relies on currency exchange in order to take place. In the zone, there are some 180 different currencies in the world, and it can be difficult for currency traders to remember them all. Fortunately, there is a system that abbreviates the name of each currency in 3 letters. This system is explained here. Use the arrows to advance or to review slides. Exchanging currency. Why would anyone want to trade currencies? Well, if you travel to Europe and you only have US dollars, it will be difficult to buy anything. The euro is used in most European countries, so if you only have US dollars, you will need to use them to buy euros. How many dollars will you need to buy 1 euro? You can find out at a currency exchange window. The amount you pay for one currency with another is known as the exchange rate. Say you are visiting Paris. To purchase goods and services while you are there, you will need to exchange US dollars for euros. The exchange rate between dollars and euros changes every day, but say that during your visit, the rate is 1.3 to 1. That means that each euro costs $1.30. 10 euros will cost $13. But why an exchange rate of 1.3 to 1? The specific exchange rate reflects the relative strength of the economies of the currency zone. This is determined by the global currency exchange market, which takes into account factors such as GDP, unemployment, inflation, and potential for future growth. Changes in exchange rate. The exchange rate changes from one day to the next. In fact, it often changes within a single day. Changes in the exchange rate affect how much money people from one country can spend in another country. If the exchange rate for euros changes, that changes the number of euros your US dollar can buy, which in turn changes how much you can buy in Europe with a given amount of dollars. Imagine that you are buying a cup of coffee in Italy for 3 euros. How much is that in dollars? It depends on the exchange rate, of course. If the euro exchange rate is $1.30, then the cup of coffee costs $3.90. What happens if the exchange rate drops? It costs only 95 cents to buy 1 euro, then that cup of coffee drops to $2.85. However, the dollar can go down too. This happens when the exchange rate for euros, or any other currency, increases. If the rate for buying a euro goes up to $1.50, you'll now need $4.50 for that cup of coffee. Setting exchange rates. Changes in the exchange rate makes things in one country cost more or less to someone from another country. But exactly how are exchange rates determined? Each currency zone has its own exchange rate regime that determines the price of its currency relative to another. A currency is classified as either a floating currency or a fixed currency based on its exchange rate regime. A floating currency fluctuates in value according to economic factors such as trade balances, inflation, unemployment, and foreign investment. The overall conditions of the economy determine the supply and demand of a floating currency, and they set its value. Fixed currencies are measured in value against something else, usually a commodity like gold. The world's major currencies began to float in 1971. Before that, they were always fixed in one way or another. Usually they were attached to a precious metal, such as silver or gold. Today, many developing economies still have a fixed currency, but more and more are switching to a floating currency regime, or at least to a more flexible one. The evolution of currency exchange. The currency exchange rates have been determined in different ways over time. The modern era has seen three major global exchange systems. The years 1870 to 1940 marked the first attempt to standardize global exchange rates. During that time, currencies were exchanged under a global fixed exchange rate tied to gold. This was known as the gold standard. The gold standard allowed for the mobility of investment capital from one country to another in a stable exchange environment. The system was flawed, however, because countries needed to hold large gold reserves to maintain the gold standard. A country using the gold standard was not allowed to print more money without first increasing its gold reserves. This limited the use of monetary policy to manage the nation's economy. During World War II, some 40 nations, led by the United States, convened the Bretton Woods Conference to regulate international currencies and create financial stability after the conclusion of the conflict. The conference established basic rules and regulations governing international exchange. A new international monetary system was set up along with an international body, the International Monetary Fund, IMF, to promote foreign trade and maintain the monetary stability of member nations. Under the new international monetary system, currencies were once again fixed, but this time to the US dollar. This meant that the value for every currency in the system was directly linked to the value of the US dollar. The dollar itself was fixed to the price of gold. If you needed to buy Japanese yen, the value of the yen would be expressed in US dollars, whose value was determined by the value of gold. The modern currency exchange system began in 1971. At that point, the US dollar was unable to keep up with the price of gold. President Richard Nixon responded to this situation by taking the United States off the gold standard. This meant that the U.S. government no longer promised to redeem its dollars in actual gold. From that point on, all currencies began to float without ties to an external standard like gold. Floating free. Today, most of the currency in the world are floating currencies. Floating exchange rates change constantly. Like other prices in a free market, floating exchange rates are set by supply and demand. A floating rate is often called self-correcting. This means that the rate is constantly corrected in the market by the dynamics of supply and demand and their effects on economic activity. For example, if demand for products from the United States is relatively low, demand for the US dollar will be low as well, because fewer dollars are needed to buy US products. With decreased demand, the price of the dollar will decrease. Recall that a dropping dollar makes the exchange rate for other currencies higher, which makes goods imported from these other countries more expensive than the United States. This, in turn, increases demand for domestically produced goods and services, which creates jobs and raises production levels. With higher production, prices for U.S. products will begin dropping, which will increase international demand for these products. As demand increases, purchases of U.S. dollars will increase to pay for these goods, meaning that the price of the dollar will rise again. In this way, the floating exchange rate allows self-correction to occur in the market. Pegging a currency. A fixed currency is one in which the government or central bank sets the official exchange rate. A fixed exchange rate system is designed to maintain currency value within a very narrow range. The central bank keeps the rate from deviating too far by fixing its exchange rate to that of another currency or commodity that has a high level of stability, usually the US dollar, the euro, or the price of gold. This is known as pegging the currency. Fixed exchange rates are used to foster a stable atmosphere for foreign investment. With a fixed rate, investors always know what their investment value will be. They do not have to worry about daily fluctuations, cutting into their profits. A special market. The currency exchange market is a special market. For one thing, it is the largest market in the world. Every day, between 2 trillion and 4 trillion is traded on the currency exchange market. By comparison, the trading volume on the New York Stock Exchange averages between 25 billion and 40 billion per day. The currency exchange market is different from other markets because it operates constantly. At any given time, in some part of the world, many people exchange currency. Continuous trading distinguishes the currency exchange market from other markets, where trading closes each business day and resumes in the morning. The sun never sets in the currency exchange market. Another thing that makes the currency exchange market different is that it is one single global market. There is no central trading place for currency exchange as there is for stocks, precious metals, or other commodities. Currency investors. Currency exchange takes place because of international trade and travel. Like the other financial markets, there is also a secondary market where investors buy and sell currency. In fact, most of the trading in the currency exchange market is done from investors and speculators. These traders are trying to profit from changes in exchange rates. Speculation accounts for about 80% of trading in the currency exchange market. The logic of speculators is simple and familiar. Buy low. For now, this is the end of 4.07 Morning Markets 2. We'll begin the next recording on slide 14. Please let me know if you have any questions or concerns, and I hope you have a great day.